A lot of people show the long-term charts, or they don't even show charts. They just say, "Oh, in 1980 it reached that high, in 2011, and then it dropped." But if you look at a really long-term chart of gold, for example, from 1970 till now, and logarithmic, because a lot of times they show these like normal charts, which uh, don't reflect the price on a percentage basis, and they look really steep. They look like a massive bubble. But I, I mean, the charter gold monthly. Well, not much really. At least not my silver coin. It's still a silver dollar. I think it's just a lot of shenanigans in the COMEX and over-the-counter uh, foreign exchange market based in New York and London, and that's what it's about. And on Friday, yes, silver came off uh, like early in the day, London time, down to like 95, I think, and then it rebounded a little bit, and uh, and then after the physical market in London kind of uh, closed after like 3:30 p.m. London or 10:30 a.m. New York time. The bullion banks, and whoever came in and flooded the market with paper shorts, and that took the market down to like 73 from like almost 100 in a matter of minutes. And it's crazy, and it scares people off. And I think, of course, silver had rallied strongly from like the end of December till Thursday. It made a high at 121. We were down in the low 70s at the end of last year. So yeah, it needed a correction, but I think it was used by the usual suspects to accentuate it even more, to try to scare off the people that are going on to COMEX and buying like contracts. For example, January contracts, which was in the front month, they bought almost 10,000. Well, they bought 10,000. They took almost 10,000 contracts of delivery, which is 50 million ounces, which is unheard of for a January contract. And I see that in February, they're already doing the same. They've already asked for over 2,000 contracts in delivery the first 2 days of February. And what the bullion banks, I think, are trying to do is discourage these people by, creating an artificial price so that they'll stop trying to clear out the COMEX of its registered silver inventory, and the LBMA for that matter as well. And we've noticed as well, Jesse, that the silver price in China is still the premium's still there. I think it's still trading around 100 now. It has come off, of course, but big discrepancy.
The sharp decline followed a powerful rally that began late last year when silver climbed aggressively from deeply depressed levels. A pullback was inevitable, but the scale and speed of the drop suggest something more deliberate. Large paper short positions appeared all at once, overwhelming bids and forcing prices lower. Historically, these tactics discourage physical buyers and futures traders from demanding delivery. Yet despite the sell-off, delivery requests surged. Tens of millions of ounces were claimed in off-month contracts, activity rarely seen. That behavior signals confidence, not panic, beneath the surface.
So I think that's what's going on. Unfortunately, it's going to discourage a lot of people to get involved, and maybe even the people who got in late, who thought it was a good thing to do. Even people who are just buying physical, they're getting out. I think a lot of people are concerned that this is like 1980 and 2011, and silver's going to drop, and we're never going to see it go back up again. I, I'm holding to my guns, and I believe we're going a lot higher because the fundamentals haven't changed. If anything, things are getting worse, geopolitically, economically, socially. I mean, there's so much mess going on, not just in the US, but also in Canada, in the UK. The whole of the West is like seems to be crumbling apart. And yeah, I don't trust the people in charge, the politicians nor the bankers, because the bankers seem to be in charge. Jesse, I saw a story in the FT that one of the guys in that list. I don't like to use the name of the list, but everyone knows the list I'm talking about that's just come out. Well, there was a minister in the UK. He became ambassador to the US last year. He's had to resign. He resigned months ago from that because he was in that list. And back in 2009, he was giving information to JP Morgan about UK policy before anyone knew about it. So yeah, the bankers and the politicians are in bed together, and I don't trust them. So I'm holding on to my gold and silver. Probably, hopefully, try to get some more, if anything. So that's how I see this these last couple of days. And I've said to viewers in the past of my channel that you need to be even keel, have an even keel. You know, when gold and silver are going up like they have, keep cool. Don't get too cocky. And then the same thing now. Just it's a psyop, really. They don't want the general public to be financially independent, and they do that. They don't care, and also they're trying to cover them, their financial situation, because they have huge short positions in paper, and if anything, this has probably exacerbated it. And I don't think the big institutional, even central bank buyers are going to stop. They don't care about a little correction in silver. They're going to come back and try to get more physical. I saw that President Trump just announced a $12 billion fund to secure rare minerals. I mean, so yeah, silver's part of that. And so I think it's, the wrong time to get out.
While Western paper prices fell, silver in Asia continued to trade at a clear premium. In China, prices remained significantly higher than in New York or London, highlighting a growing disconnect between financial benchmarks and physical markets. Arbitrage should normally close that gap, but it hasn't. That suggests metal is scarce where it matters most. When premiums persist across regions, it's often because supply can't move fast enough or because holders refuse to sell. This divergence tells a deeper story. Global demand hasn't weakened, it's shifting away from paper-based systems.
Yeah, I mean, they've been doing it for decades. They did the same with the Hunt brothers. They always favor the big banks and the big dealers. And do you remember, I think it was Boxing Day, which is December 26th. I think silver was up like 10 cents, more than 10%. And they came out and then they closed the market for like 6 hours. It wasn't even a circuit breaker. And they used this excuse of this data center that there was a glitch or something. But Friday, nothing, right? Was down more than 10%. I saw a headline today on X that one of the Chinese markets, I don't know if it was the Shanghai Gold or Futures Exchange, they used the circuit breakers today to halt because silver went down quite a bit. So they're doing their job. But they will do whatever it takes to help the bankers, because the bankers really are in charge. The COMEX CME, it's now a public company. It used to be owned by the yeah, the people who traded in the exchange. You could be a partner. You could have gone and bought, a seat on the COMEX, but now it's owned all by the big financial institutions like BlackRock and others. I haven't looked exactly, but they're going to favor. Yeah, they're going to favor these people, and if they're in trouble, uh, they're gonna play dirty. They played dirty back in 2021 in the first silver squeeze movement. I mean, the head of the CFTC even said, "Oh, we had to tamp down the price of silver." I mean, for the regulator to say that. So yeah, no, David Jensen is right. And I think even today they didn't use it. I mean, we were down quite a bit earlier, and I didn't see the market stopping. Maybe it did, but yeah, they'll. I think, Jesse, what this shows is that they're really desperate, and but I don't think it's going to work because we're not in 1980 anymore. We're in 2026, and there's a lot more interest in silver and a lot more exchanges where people could move to buy real physical silver and gold. COMEX and LBMA, if they keep up with their shenanigans, there'll be history.
Price shocks are effective because they play on memory. Many investors still remember past collapses and assume history must repeat. That fear causes late buyers to exit and sidelines new ones. But today's environment is different. Institutional and sovereign buyers aren't reacting emotionally, they're securing material. Industrial demand is rising, strategic stockpiles are growing, and governments are openly funding mineral security. Short-term price damage may shake retail confidence, but it doesn't change the underlying trend. Volatility is being used as a psychological tool, not a reflection of fundamentals.
A lot of people show the long-term charts, or they don't even show charts. They just say, "Oh, in 1980 it reached that high, in 2011 and then it dropped." But if you look at a really long-term chart of gold, for example, from 1970 till now, and logarithmic, because a lot of times they show these like normal charts, which uh, don't reflect the price on a percentage basis, and they look really steep. They look like a massive bubble. But I mean, the chart of gold monthly going back to 1970, yes, it's taken off since the beginning of actually 2024. And yeah, it's really taken off in 2025 and 6. But if you look at what it did in the 70s, we're not even like we haven't even matched what the price did in the 70s. And I don't discount the fact that we need corrections. I even said about a month or 6 weeks ago, when gold was like taking off, when it broke 4,400, and it was trading around 48, that I thought we could go pretty much nonstop to around 53, 54, and that we could see a correction. And I guess we did. But I think, yeah, the bankers, they used it as an excuse to smack it even more. But yeah, the reason I think it's going to be different this time is that the fundamentals are still there. The debt is still there. The leverage in the financial system is still there. Geopolitically, we just saw China announce this weekend, Xi Jinping, that they really want to push their currency as the major reserve currency. So that's a challenge to the dollar. We're seeing even allies of the United States not very happy with the treatment that President Trump is serving them, right? And they don't want to be also as dependent on the dollar. So, yeah, and I don't really see any way out. People are talking about Warsh. I don't know if you want to go into him now. that he's going to be like Paul Volcker. And I think that's complete baloney, to be honest, because Paul Volcker, he he let rates go to 20%, I think the discount rate. And at the time, though, the debt to GDP was 35%. And you had a really bad recession in 1980, and then another one in 81. It was like a double dip. And Jimmy Carter lost the election in 1980 because of that. So if Warsh is going to be tough and wind down the balance sheet, and I've heard people say that, oh, he's going to help Main Street, not Wall Street. But I don't see how he can do both. I mean, there is one thing that he could do to help Main Street, and that would only be like a sugar rush, temporary sugar rush. And that would be to revalue the statutory price of gold, like from 42.22 to around where we're now. And I've calculated that the Treasury would get a $1.2 trillion windfall. They could use that to buy back some of the I think 4 trillion or so that the Fed owns of treasuries. They could do that, and then send some of it as well. Send a check to the people at the bottom who are suffering, and then they might, do well in November this year, the election. But yeah, if you look at what he said, he thinks rates should be down to around 2 or 3 or 4%, 2 or 3. So he sees room for rate cuts. So I'm not sure how he wants to do quantitative tightening. I mean, that's the opposite of loosening policy. So I think people use that as well. Or maybe the algorithms saw, well, Warsh is going to be chairman. But why would Trump bring in someone that's really hawkish if he was having such an ugly battle with Jay Powell for like over a year? They opened a criminal investigation, into him. Why? Do you really think he's going to pick someone? Trump is going to pick someone that's going to be like even worse than Powell, because Powell has been cutting rates. So yeah, that's why I think things are not like 1980 and 2011. That's the way I see it. I could be wrong, but I'm keeping my money where my mouth is, like my metals. The last place I want to put too much money in or fiat currency in is with the banks.
Trust in financial leadership is eroding across much of the Western world. Political instability, debt expansion, and regulatory favoritism have blurred the line between public policy and private banking interests. Exchanges once owned by traders are now controlled by large institutions whose priority is stability, not price discovery. When markets move violently in one direction, safeguards often fail to appear. Elsewhere, trading halts are enforced quickly. That imbalance reinforces the belief that the system protects leverage, not transparency. In that environment, tangible assets regain credibility by default.
Yeah, I think now that is not as important anymore because he's picked his new candidate, and I'm not sure what's going to come out of that. Unless Powell were to like raise rates in the next meeting, I think he'll be okay and he'll just retire from the Fed and probably get a job at BlackRock or something.
Yeah, exactly.
Actually, I don't. I think silver is really on it's a different kind of energy now, silver, after we broke 50. And so I think when silver recovers, it's going to really motor ahead. Not that gold won't either, but I think, when things pick up again, silver will do even better. So, yeah.
This isn't 1980 or 2011. Global debt is far higher, Currencies face direct competition, and capital can move instantly across borders. Precious metals are no longer niche hedges, they're strategic resources. Corrections will happen, but they don't erase long-term forces: rising demand, constrained supply, and declining faith in paper promises. Silver, in particular, sits at the intersection of industry and money. When it recovers, it tends to move fast. For long-term holders, this phase looks less like an ending and more like consolidation before acceleration.